All right, we're about to dive into a fascinating and honestly a pretty intense thought exercise. It's a story from the near future, pieced together from what's basically a memo looking back from June 2028 on a massive event it calls the Global Intelligence Crisis. And this, right here, is the central paradox we're going to explore. It's a wild idea. I mean, we've all been so focused on the incredible upside of AI, right? But this scenario flips the script. It imagines a world where AI success goes beyond our wildest dreams, and the economy pays a heavy, heavy price for it. So let's just go there. Picture it. It's June 30th, 2028. The S&P 500, it's down a whopping 38% from its highs just a couple years back. Traders are just numb. That crazy optimism we felt back in the mid-2020s feels like a lifetime ago. And then this number flashes across the screens, 10.2%. That's the unemployment rate. And what's truly insane is that just 6 months ago, a number like that would have triggered circuit breakers, it would have halted all trading. But today, it's just another Tuesday, just another bad day. So that's the multi-trillion-dollar question, isn't it? How did the economy go from having what everyone called contained issues to a complete, full-blown crisis in only 24 months? Well, to figure that out, we've got to rewind the clock. We have to go back to where that very first domino started to wobble. So our story really kicks off in late 2025. And it doesn't start with a bang, not at all. It starts with this quiet little revolution happening inside the world of software development. This was the first tiny tremor before the earthquake hit. And wow, did it happen fast. First, these AI tools that could write code got scary good, almost overnight. All of a sudden, a single developer could basically clone the core features of a huge software product in just a few weeks. So by the middle of 2026, you've got corporate buyers asking, wait, why are we paying $500,000 a year for this software when we could just build it ourselves? The real breaking point, though, was ServiceNow's earnings report. They announced layoffs, slowing growth, and the stock just cratered. And that's when the market finally woke up and realized the entire software-as-a-service business model was in serious trouble. Now, this is where a really dangerous feedback loop kicks in. You'd think these threatened companies would fight the new tech, right? But they couldn't. To deal with the pressure on their stock price and slowing growth, they had to cut human jobs and then pour that money right back into the very AI tools that were eating their lunch. It was a perfectly rational decision for each individual company. But when everyone did it at once, the collective result was absolutely catastrophic. This whole thing created this huge disconnect in the economy. See, on the surface, everything looked awesome. Headline GDP numbers were booming, productivity was through the roof. But that growth, it was being generated by a GPU cluster in North Dakota, not by 10,000 workers in Manhattan. That money never ended up on a human paycheck. It was never spent at a restaurant or on a family vacation. They started calling it ghost GDP. It was there on paper, but completely invisible to the real human economy. So you get this self-reinforcing death spiral. The AI gets better, which leads to layoffs. Those now unemployed workers spend less money, which hurts other companies' bottom lines. And to survive, what do those companies do? They're forced to invest in the exact same AI to cut their costs, leading to even more layoffs. It was just this vicious downward cycle with absolutely no breaks. But, software was really just the beginning. By early 2027, this disruption had escaped the tech world. AI agents became this default thing, just running in the background of everyone's life, optimizing everything. And they started to dismantle entire industries that were built on one simple human thing: friction. Let's just take DoorDash as an example. Their whole business was basically built on what you could call habitual intermediation. You know how it is, you open the app you always use just because it's easy. But an AI agent, it doesn't have habits. It never gets lazy. It can instantly check every single option. DoorDash, Uber Eats, the restaurant's own website, 30 other competitors, and find the absolute rock bottom price every single time. That habit, that little bit of friction, that was DoorDash's entire moat, and it just evaporated overnight. And this wasn't just about getting your dinner delivered. Any business that made money by navigating complexity that we humans just find tedious was suddenly on the chopping block. AI agents could reshop your car insurance every year, find the best travel deals in a split second, and even negotiate real estate commissions down from 3% to less than 1%. I mean, decades of businesses built on just human inertia and having more information than the consumer, they just vanished. Okay, so we've got a major crisis brewing in the real economy. White-collar jobs are disappearing, and entire business models are collapsing. The next stage of the story is how this infection spread from Main Street right into the heart of the financial system. The trouble started in the private credit market. See, this market had funded a massive boom in private equity buyouts of software companies. And those deals were all built on one core assumption, that software revenue was super stable and predictable. But as we just saw, AI completely shattered that assumption. Defaults started trickling in, then pouring in, and it all came to a head with the massive Zendesk default. That's when regulators got spooked, and the whole house of cards really started to wobble. There's a quote from the Fed chair at the time that just perfectly captured the problem. The entire financial system, from private equity all the way down to insurance, had basically made this gigantic, leveraged bet that the value of white-collar work would just keep going up and up forever. And when that bet went sour, all the hidden risks came to light. And here was the hidden time bomb. Everyone thought the private credit market was safe, funded by permanent capital from these big, sophisticated investors. But that wasn't the whole story, not even close. A huge chunk of that capital was actually from life insurance companies that had been bought up by big asset managers. So the money backing these software loans that were now defaulting, it was the annuity savings of regular American households. Main Street was on the hook, and they didn't even know it. So at this point, the crisis is systemic. It's everywhere. But there was one more shoe to drop. One market so fundamental, so massive, that if it failed, it would make everything else look like a picnic. This was the terrifying question that was hanging over the entire market in 2028. The whole $13 trillion U.S. housing market is built on one simple belief, that a borrower with a good job will keep having a good job for the next 30 years. But what happens when the very idea of a good job is structurally broken? We started seeing mortgage delinquencies spike in these tech-heavy zip codes among people with 780 FICO scores, the people who were supposed to be completely bulletproof. Okay, let's just pause for a second. Everything we've just walked through, the market crash, the job losses, the financial contagion, it feels pretty grim. But here's the single most important part of this entire story. You are not living through this crisis. That's the big reveal. This whole macro memo from the future was a scenario. It wasn't a prediction. It was written today, in our time, to model a potential risk that people weren't really talking about. It's a work of financial fiction, really, but one that was designed to make us think. And that brings us to right now, to where we actually are. Those negative feedback loops we talked about, they haven't started. That financial daisy chain hasn't been pulled tight. The canary in the coal mine is still breathing. Now, the trends described in this whole scenario, the rapidly improving AI, the pressure on white-collar jobs, new kinds of competition, those are very real. But the crisis itself, it is not inevitable. And that's the final question this whole thought exercise leaves us with. It makes the argument that for maybe the first time in history, our most productive asset, human intelligence, might start producing fewer jobs, not more. Our old economic models just might not apply anymore. The story we've just heard is one possible future. We still have time to look at these risks and maybe, just maybe, write a different ending. The only question that really matters is, will we?